Man, is it noisy. I mean, it is a cacophony of chaos from every cackling talker on the market. And I'm here to add more noisy noise to this unharmonious conversation. But hopefully, my noise is more signal and will cut through the rest to bring some levity. If you haven't heard, the S&P 500 is down 9.3% since its high point on February 19th of 2025. And apparently, it means the world is ending. Welcome to the Quality Investor. The Nasdaq, by the way, is down 13% from its peak on February 19th. Truth be told, I'm heavily weighted towards tech in my portfolio, so I'm really feeling some pain. Or am I? Something I learned long ago was nothing in the market is actually real until you sell. And that works both ways. When the market is flying high, those gains aren't real. Not until you sell and realize that gain. In other words, convert stock to cash. But cash by itself is useless. It doesn't work for you in any way. It exists to facilitate spending, or a much wiser use of cash, after basic needs are met, of course, to facilitate investing. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. My point to all of that is this: nothing is real until you decide it is real. Is my portfolio down this year? Sure, on paper. But I haven't sold anything, and I don't plan to. I haven't lost a thing. I hold 19 stocks in my portfolio, and I believe every single one will be worth more on paper in 5 years than it is today. And that is the essence of quality investing. We buy great businesses. We hold great businesses. And over time, we will win. We don't speculate. We don't time the market. We don't trade based on bogus technical lines on a chart. We buy quality. And because we buy quality, a falling market does not affect us. Not emotionally, not mentally. I sleep as soundly today as I did 2 months ago. So, what is going on? Why does it not matter? And how can we benefit? Now, I must admit, one emotion has crept in: excitement. And how can you not be excited by some of the great sales going on? But I digress. This video is about mentally orienting yourself during these bust cycles. As I've said on many occasions, I don't prognosticate about the market. I don't make predictions about the economy. That's because I don't care. Microsoft isn't going bankrupt in a recession. They are going on sale, though. You see, the whole premise of buying quality businesses is that they're quality in good times and bad. The fundamentals of the actual business aren't altered because there is fear in the economy. Sure, some declines may occur in earnings and cash flow, but a quality business is a quality business because they're built to withstand temporary shocks. And that's all this is, a temporary shock. And remember, my ideal hold period is forever. So in that context, temporary can mean months or even years. But in the short term, I want to point some things out. Many commentators are commentating on what will happen. Recession is incoming. Tariffs will drive up inflation. Unemployment is rising. Just look at this tweet here. It sums it up succinctly. Unusual Whales posted a quote from David Kelly of JP Morgan. The trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they're fine. Keep in mind, a recession is broadly defined as a decline in economic activity, and quantitatively as a decline in GDP for 2 consecutive quarters. The last one occurred over Q1 and Q2 of 2022. The S&P fell over 20% during that time. We are less than halfway there. Inflation is the other big concern. Inflation caused by tariffs. Depending on who you ask, inflation is coming down. Some see that as a good sign. Others are not as optimistic. Rennie Zucker says recessions lower inflation in the same way dying lowers your blood pressure. Inflation is a sustained rise in the price of goods and services over time. In economic terms, former Fed Chair Ben Bernanke defines it as inflation occurs when the aggregate quantity of goods demanded at any particular price level is rising more quickly than the aggregate quantity of goods supplied at that price level. A tariff is in effect a tax ultimately passed to the consumer. In theory, a price increase from the supplier should lower the demand of a product. So, are tariffs inflation, according to Bernanke? Is there collectively more demand for Canadian goods all of a sudden where supply is now constrained? Are there viable alternatives in the market to, say, maple syrup that Americans can buy, which shifts demand to the alternative and in theory increases prices? Because I can't imagine supply of Vermont maple syrup suddenly matched to this newfound demand. To me, this is all just a silly game. All of this is theory. It is what ifs and hypotheticals. Theory does not matter. Reality does. And that is what I want to quickly demonstrate. I steadfastly discuss the importance of fundamentals when buying great businesses. A proxy to use for the overvaluation of a stock is the rise in share price backed by earnings and cash flow. The dot-com bubble is a good example. Valuations were pushed to insane heights simply because they were an internet company. Many of these companies had negative earnings and were bleeding cash. Well, that bubble burst. But what about today? There were certainly some stretched valuations. But are revenues increasing? Are earnings? What about free cash flow? If these are going up quarter after quarter and the share price is going down, you stand to benefit mightily by the temporary dip in share price. So let's take a look. This is a high-level screener I like to use to dwindle down the list of my investable stocks. I update this each quarter to get a good idea of how each of my preferred metrics are growing over various periods. Right now, I'm filtering on just the S&P 500. You can see a ticker count here of 500. And I'm looking at a period of 1 year, meaning the last full fiscal year for each of the businesses here. So I said, is revenue growing? Are earnings growing? Is free cash flow growing? Now keep in mind, the markets are forward looking. So obviously past growth isn't going to necessarily alter what the expectations of future growth are going to be. But previous price appreciation is baking in historical growth. So you can see over the last 1 year, revenue has grown collectively 4%. I'm using a median here instead of an average to lessen some of the noise. And one example of a massive run-up we've seen in the stock market is, of course, NVIDIA. And if we look at NVIDIA, their revenue year over year is up 114%. Their earnings up 146%. Their free cash flow up 126%. This is a business whose massive share price increase over the last year is backed by earnings, backed by real numbers. Will this continue into the future? I don't know. But right now, NVIDIA has a PE ratio of around 37-38, which is not all that high given what NVIDIA has done over the last year. But what I really want to do is convey that there are many businesses currently growing in the core fundamentals. So for example, now I'm looking at every single business who's grown their revenue in the S&P 500 over the last fiscal year. And of the 500 businesses, 351 have grown their revenue. That's 70% of the S&P 500. But what about revenue and earnings? How many businesses have grown both over their last fiscal year? 243 out of the 500 businesses in the S&P 500, just under half. And for the businesses that have grown both, the median revenue growth is at 7.7%, and the median earnings per share growth is at 22%. And now we're looking at businesses that have grown their revenue, grown their earnings, and grown their free cash flow. And that comes down to 135 businesses, just over 1/4 of the S&P 500. But what's important is these are your quality businesses. These are the businesses that are consistently growing. If we look at it on a 3-year basis, you see the number creeps up a bit to 165. But scanning through the list here, you're going to notice a lot of the same businesses on both lists. The point is, quality businesses are going to grow despite the environment they're in. They may not grow much. They may have a small dip one year, but over time they will grow. Is their rise in share price backed by real growth in the fundamentals? So over the last 3 years, Airbnb, for example, their share price has been falling a lot. I did a video on Airbnb a few weeks ago, but over the last 3 years, they've grown their revenue by 22.8%, their earnings by 109.6%, and this is compound annual growth, by the way, and their free cash flow by 23.6%. Their share price has just come down. Another way to think about it is, what is each sector of the economy doing? Here we're looking at the technology sector. 80 businesses from the technology sector make up the S&P 500. Of those 80 businesses, 59 of them have grown their revenue in the last year, right around 75%. And the median revenue growth, 8.8%. And the median earnings growth for those 59 businesses, 20.85%. And they've grown their free cash flow at 20%. So technology is certainly backed by real growth, unlike what we saw in the early 2000s in the dot-com bubble. But now let's look at the energy sector. The energy sector is a very important sector because it fuels basically everything that we do in our modern economy. 22 businesses from the energy sector belong to the S&P 500. Of those, 12, or just one above half, have grown their revenue in the last year. I think energy is a lot more cyclical, so it's not going to tie exactly to how the broader economy is doing. Energy could be down in some years when the economy is exploding, but we're still seeing some growth here. And another very important sector is industrials. This is the logistical operations of our economy, the manufacturing of our economy, what many would consider the backbone of our economy. 72 businesses from the industrials sector belong to the S&P 500. 47 of those have seen growth, and nice growth too, at 6%. And they've also done a very good job growing their earnings and their free cash flow, both above 10% on the median. But to me, there's another very important proxy to look at, and that's the consumer sectors. The consumer sectors are a very good reflection of what the broader average American is doing. Are they spending money? 92 businesses from both the consumer defensive and the consumer cyclical sectors make up the S&P 500. Nearly 20% of the entire index. And some very important companies belong to this sector. We have Amazon, Airbnb, Nike, Tesla, McDonald's, some big players, and not only in the Magnificent Seven, but in the Dow Jones as well. And in the last year, 64 of those 92 businesses have seen growth, over 2/3, and especially in businesses that are very dependent on discretionary spending. Royal Caribbean, a cruise line, Carnival, another cruise line, Chipotle, you could say it's high-end fast food, Airbnb, Booking Holdings, Norwegian Cruise Line. So we're definitely seeing real growth, in my view, in this economy. I don't know what that portends in terms of a recession. Remember, the recession is 2 consecutive quarters of economic decline. But what I'm focused on is, are the businesses that I want to buy actually growing their core fundamental metrics? And so far, the answer to me is yes, at least the ones that are quality in my view. So the whole gist of this video was basically ignore the noise. It's not important. It's not going to help you become a better investor. What'll help you become a better investor is focusing on the fundamentals of the businesses you believe in, understanding the future growth potential of the businesses that you believe in, and then buying the businesses that you believe in when they're on a very good sale. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.